Thank you for joining iMeet. When you hear the tone, you will be the 17th person to join the meeting.
Everybody, this is David Blake with our Tuesday Tech Talk. And today we're going to quickly review last week's market action, see what's going to happen over the next couple of days, and then we'll open it up to questions at the end of the period. Generally, we talk about 20, 25 minutes, and then you can ask about whatever the topic we're talking about or any individual stocks, something like that. But the subject of today's talk is, can we get a year-end rally out of this market that just keeps muddling forward here, grinding forward? So we're going to look at a few charts, and then we're going to look at, we're going to talk about the CTI. For new viewers, the CTI is a proprietary indicator that we have at MarketEdge. It's called the Cyclical Trend Index, and it's our forecasting and market timing indicator that we use. It's been in place since about 1974. It's outperformed the Dow about over that period. It makes about 3 or 4 calls a year. So on Friday, we actually flipped the CTI to a positive bullish read on the market, the positive +2 on the count. We closed out our triple leveraged index funds, the ETFs. We went to the short ETFs at the close or Monday morning, wanted to do. The ones that we were short, that we went short on May 29th, I believe, when the Dow was at, I think the Dow was at 18,491, I believe. But anyway, the short Dow, we made 3 3/4% since May till, I'm sorry, from September 2nd, my bad. September 2nd, we went to a short on the Dow when it closed at 18,491.96. So we covered and went long this past Friday when the Dow was at 18,145.71. So we picked up about 346.25 points. As of last Friday, the Dow Jones was up 720 points or 4.1%. And timing the market using the MarketEdge method, we were up 15.4%. We picked up 2,676 points. That's as the close of last Friday. 2015, the Dow was down 2.2, and the CTI MarketEdge timing model is up 18%. So we've done pretty well. If you've been going the long and short and leveraged ETFs year to date, as of the close on Friday, we're up 46%. So we're having a pretty good year. And like I say, we closed out the short position when we went long last Friday. If you're fairly new, these are the ETFs that we bought on Friday at the close. And we always have to make these things the discipline. So we close them out at the close on Friday, and we open a new position at the closing price. So the Dow, we bought at 72.81. And what I try to do on this thing is we usually split the ETF. If you have $10,000 to put into the thing, you're going to put $2,500 into each one of these ETFs. These are the prices that we paid for this round for the long period. The reason we do all 4 of them, just for instance, from May until September, I think the Dow was up, the triple leverage was up about 13%, but the 1,000 was up almost 25%. So occasionally you're going to do well. Going back again, you'll see that we did lose on the last call. We lost 4.8% on the short NASDAQ. We had a pretty good run here the last couple of weeks and put that negative, but we also made 5.4% on the Russell 2000 this time. So all in all, I think we were up about 3 3/4% for the whole ride. Not much for a sideways market. Okay, what we're going to do now, we're going to talk a little bit more about the CTI. Last week was kind of a choppy week. We flipped it on Friday, like I said, and the reason we moved the market to a bullish count was mainly because of the momentum index. What we try to do, the momentum index measures the market's momentum by, it compares the strength and weakness of several broad market indexes to the Dow Jones. When the other indexes are outperforming the Dow, it's bullish, and when they underperform, it's bearish. So what I do is I take the lows for all the other indexes and compare it to the Dow Jones And in this case, we took the lows from September and October to see what has outperformed or whatever. And then we also threw in some breadth numbers, such as number of new highs, the AD line, that kind of stuff. And as of the lows that were hit in September and early October, only the American Stock Exchange has underperformed the Dow Jones on those different indexes and indicators that put on a bottom. Thus the index or the momentum index was able to go from a -6 negative to a +8, which is pretty positive. The transportation index off its low has come up about 4.08%. The S&P was up 1.25, Nasdaq's up 3.13, and the Dow Jones is only up less than 1%. It was up 0.99% as the close on Friday. So that's what why we flipped it over to the bullish position. And sentiment, we're not getting much out of the sentiment index. It's been neutral for several weeks at a +2. I don't see a big exuberance of bullish or bearish sentiment in either one, although you can find pockets of both by different analysts. Okay, so the market breadth was positive. The AD lines for both the NYSE and NASDAQ moved up. Yesterday we saw a pretty nice expansion in the number of new 52-week highs versus new lows, which was a pretty welcome sign. So let's take a look at a couple of the indexes before we go a little bit deeper into the CTI. Certainly you're not going to get this. Here's the Dow Jones as it closed yesterday. You're not going to get, no one's going to get too excited about this chart, but we've been kind of in that sideways consolidation period. However, and you always want to make sure you're not picking and choosing indicators that fit your opinion on this. What some technical analysts will take a look at stuff. If they've got an opinion that they think we're bullish, you can always find an indicator that's going to match what your opinion is. So you want to make sure that you don't you let the indicators tell you what to expect. So you're not trying to guess what the markets. You're not forecasting what the market's doing. You're just reading what the indicators are telling you. But so the only time you want to interpret what the charts indicators tell you, you'll only be wrong when you start to bend the indicators to agree with what you think it's going to do or what you want it to do. Okay, so what's bullish? Okay, we tested several times this old support level going back into the summer, and now we've kind of come off that. Now here's the Dow. Yesterday we were able to close back above the 100-day moving average. We're kind of under that right now, but only by a couple points. And what we want to try to look at over here is we want to see this thing solidly. We ran into this downward, this descending trend line yesterday at the high, and we came back. We still closed above the 100. So that was pretty good. But for this thing to to start to really get some momentum and oomph behind it, we want to see it close above this descending trend line and also around this 18,313. At that point, 814 comes in. That's the highs that we've kind of turned it back over in here throughout the last couple of months. But if we can clear this area, we have a chance for the Dow over the next couple of weeks to possibly run up and make a new high. So you kind of want to watch that. You don't want to short a dull market. In this case, I think there's a chance that we could, like I say, if we get above 18,350 or so, we could take a stab at the old highs. You are seeing some positive divergence going on now in the indicators. Here's a 30-day stochastic. We've crossed above 50, which means this thing's starting to show a bit of a trend. Not much. You want to see this thing get up to about 75, 80 in a solid trend. You're also seeing a little bit of a pickup in the 14-day RSI and a small uptick in the MACD short term. So we're not breaking out in here, but I say since this thing, we are getting a positive momentum, and the indicators are starting to turn around a little bit. I think that's a bit of a positive divergence. Now here's the AD line for the NYSE. Again, over the last week or two, you've seen a pretty nice pickup, of showing accumulation. We're actually only about 3,000 units off of the old high over here. So one or two good days, and this thing can pop up. Now, one of the things that I like about this right now with interest rates probably ticking up in December, we have what we call in the NYSE an AD line. And also they call it the OCO AD line, which is operating companies only. And what that means is you're not this line right here. We're going to look at. It shows you preferred stocks and interest-sensitive stocks, and you saw a lot of that under accumulation while this thing was riding up. The OCO line wasn't going as high as this thing was. But in this case, since everybody knows that interest rates are probably going to tick up in December, they're not. This isn't an uptick on more prefers or looking for utilities, that type of thing. So this is a little bit of a positive divergence too. If we can get another day or two, this thing gets up here above 360. We're almost at an all-time high on the NYSE. Another thing we saw over here, we saw an expansion here the last couple of days in the number of stocks making a new 52-week high and a number of stocks making a new 52-week low. I also checked something daily, which is how many stocks are within 1% of making a new high. And I've also seen that that's gone from about 7.5% to about 14% over the last couple of days. So that's another sign of some positive divergence underneath what's going on. You want to see this thing, go up here. This is a healthy market here in the summertime, and when we called the bottom back here in May, it's had a nice move in that this confirms when you're going higher. Okay, now here's the S&P. You're not going to see much difference in this than what you saw in the Dow. It held support over here, this 2120, 2125 area. We gapped up yesterday above the 100-day, which is a bullish little sign. And what you want to see this thing, we'll get this thing up above this descending trend line. Kind of meets where the 50-day moving average is. So if we can get above 2160, 2165 area, the S&P 500 also has a chance that we could break out to a new high. Again, you're also seeing some positive divergence in the indicators below. They're starting to show some positive signs. 30-day stochastic above 50, and also an uptick in the 14-day RSI. Here's the NASDAQ. Obviously, this chart looks pretty good to me. It came down here at a small ascending trend line here that kind of bounced off of that a few times, gapped up above the 50-day moving average yesterday into some resistance area. And what you want to look over here, we're back above that 50. You're only about 35 points going into this morning away from an all-time high, so that's pretty bullish. We had nice positive signs. This isn't really positive divergence. This is just a positive sign showing that the trend is actually moving up on this right now. So going back about a week and a half after a little short pullback, we're starting to move higher again like it was over here. And we can see this very easily break out to a new high. Here's the NASDAQ advanced decline line. Not so much. What I don't like about this is, if you remember last November, when we were starting to come off of that September lows, and we went to a sell, and our momentum indicators were showing that we just weren't seeing the expansion in the advanced decline line. We weren't seeing that going up. That was showing that there was a limited number of stocks that were making new highs and were under accumulation. That was the FANG stocks and the big cap technology stocks, and that was a sign to us that was kind of a negative divergence. So this, I'd like to see a little bit more oomph behind this before we're out of the at least to kind of confirm that we have a chance to break out to a new high. If we break out to a new high and this thing's down here still, that's negative divergence, so we want to watch that. And then we also, after the last couple of weeks, we finally were getting more new 52-week lows and highs, and we reversed that. This started picking up here in the last week or two. So this is it's not confirming a move yet, but it is showing that we are starting to see more stocks participate again. If we can see this thing get back above here, that would be a good sign. And in fact, over here with the never mind, forget it. I'm not going to go into that. So, all right. Another one I want to show you real quickly here before we go on to the CTI. This is the Philadelphia Semiconductor. So a nice gap up yesterday, a real nice move. I think it was up to like 1 3/4%. This thing moves up to a new high. That also would confirm with the other indicators, especially the NASDAQ, that we can make a new high over the next few weeks. So that's bullish for the overall market. And again, you're seeing some pretty nice movement in the indicators that are kind of backing up and confirming that we're starting to go in an uptrend on the Philadelphia Semiconductor Index. Okay, we always get back to this one. Here's the Dow Jones Transportation Index, which again could be key. I want to see this thing. We're starting to slide up a little bit. You have over here, you have a little, this could be a shoulder, head and a shoulder, or if you get a break above this thing, which really is, I wouldn't call this a breakout, but you've got this area in here that we've got to, it's got to clear this 8250 to 8300 area. That's going to get some people's attention. If we can get through above this 84, that's going to confirm that this market has a real good chance of of everything breaking out to a new high. Now, if we take it down here on a shorter time base, you can see there's a lot of sideways action here. Not much going on. If we would get we are actually starting to see a higher high, higher low, another higher high. So far, a higher low. Again, if we can break above this area here, which I believe is above 8,200, that would confirm another higher high, which is a bullish sign for the Dow Jones Transportation Index. If we break below 7,700, that's going to be the bell that this is going to be a failed rally attempt for the whole thing. Okay, the next thing I want to take a look at here, we're going to talk real briefly about the CTI and how it works. I don't want to try to get too involved in it, but I do want you to have an understanding of what this is. Now, the CTI is comprised of about 5 different cycles that resemble sine waves. Okay, the utilization of cycles in forecasting market direction is based on studies that demonstrate that stocks, as well as a lot of things in life, tend to experience, cycles, good and bad cycles. And on the stock market, we kind of experience price reversals at anticipated time intervals. So much of this is based on these cycles down here. Much of this is based on a 4-year business cycle. It's seen over over 100 years or so have shown in the business cycle you have periods where the cycle slows down and picks up, and these intervals have come on have lasted for years. So the cycles are set to highs and lows of the Dow Jones. They're comprised of 5 different time periods that will show synchronicity and also harmony. So you'll see with this one here, it ends here, and goes on here. It'll come to the same period where this straightens out, and cycle C will go through, and these things will all, at some point, they all end and convene at the same point. Okay, the cycles are going to range anywhere from 6 weeks to the longest lasting, which is 4 to 4.5 years. Now, when the cycles are set off the lows, like when the market makes a low here, this would set up a new count. We could go up to about here. This might be another count. But in this case, this would have been a low where we reset some of the cycles. Then we'll go further along here. Here's another low where we can reset the cycles. In this case, we'll reset 2. This is back from 2004, this chart, so this isn't what we're looking at right now. But as you can see how these cycles will go like that, and then when they several convene at one time, it usually indicates more of a sell-off or more of a high in the market. So anyway, the cycles all have numerical values. They're assigned that so as the cycles change and they progress, these values are moved into a round number. The shorter cycles receive higher values since they're more dominant. And if we get a reading of +1 or higher, that means we're in a bullish scenario. If it goes to 0 to a -15, that's going to indicate a bearish scenario. So the CTI, unlike the second opinion on Market Edge, is a forecasting tool and not a trend-following indicator. That's what makes this unique to our site and proprietary indicators. So you want to, we can forecast out where we project strong and weak periods of the market should come in based on the cycles. Now, it's not always cut and dried, and we do our best. We can't constantly update these cycles. We have to go in almost weekly, where we might be going along and all of a sudden have to reset one back a week or two. And a perfect example of that would be in May, the cycles were reset to go to a buy on May 29th. Okay, well, 6 weeks later, we had the Brexit vote, and that occurred, and the market sold off and made new lows. So the confusion here is, so what do I do? Do I keep the CTI set for the May 29th lows, or do I extend the old cycles out and have a new low for the July 7th bottom? So what I had to do was I had to run 2 different models to see where they would fall back into place. And so this last week, I had extended the original one out about a week or 2 because the market really wasn't doing anything. But then when I saw the momentum index pick up, I was able to actually we ended up just extending the the May lows out, cycles out about 2 weeks, and that happened. Now we're back in sync, I believe, unless we really have a big sell-off this week. But right now we should be back in sync, and the model that I ran off the Brexit low was going to go to a sell, I believe, next week anyway. So I think we're in pretty good shape. We'll find out. If we would make a big bottom next week, then we'd probably have to kind of reset. But at this stage, we are bullish, and I think that we can, going forward, we'll see how that is. But anyway, what the problem right now that I have is usually you don't get the cycles this short, but we're actually scheduled to probably go to a sell again anywhere for the next 2, 3, 4 weeks. What the cycles are projecting, we are going to actually bottom out on all the cycles. It looks like around sometime in December, possibly around the 1st of January. So this bullish cycle may only last until the shortest, maybe November 11th. It happens to coincide with the election, presidential election. And what I would probably do is let this thing run. For the first sign of weakness in the market, I think I would probably take my profits and look to be exiting some positions and look for more of a pullback throughout the rest of the year. Now the good thing about it is once we reset the cycles either in December or the 1st of January, we're projected to remain bullish going out probably, I think, into July of 2017. So because you'll have that reset, I think that should be the start of our next bullish market or business cycle, and that could project us out, I say, for a pretty nice spring for the market. But until we get that recycle, it doesn't have to be a 10-20% dip in the market, but it usually is when you have everything reset. It's more like this, where you have a pretty good, you can see the bottom was hit there, and then you bounce off of that. So I would expect to see something like that towards the end of the year, and I don't think that just because we have the election we're going to take off at that point. So as far as the rally at the end of the year, I don't think so. I think we have a chance that we could actually go out and make some new highs over the short term, the next couple of weeks. After that, I think you want to use those new highs to lighten up again and wait for the cycles to reposition them and see if we can get a noticeable bottom going in. Okay, so I'm going to go ahead and open this up to questions. I see we got about 4 of them already on here. Let me see if I can. Okay, what about QQQ short the last cycle? Okay, we lost. If you weren't here for the first thing, we made money on 3 of the 4 ETF trades. And that was we lost 4.5%, I think, on the QQQ. We made about 3.5% on the Dow and the S&P, and we made about almost 5 on the Russell 2000. So again, we just went to that shorted nugget of 14.55. We'll look at nugget. If interest rates go, does the bond market go down fast, and does that affect the Dow Jones S&P 500? I think, yeah. No matter what they say, even if we're kind of pricing it in, you probably still get a little bit of a downturn, and that would actually coincide with the end of the cycles, and that could be where the cycles would bottom. Generally, I've done some talks before. I'll bring it up again once we get closer in December, where it shows you on your bond holdings how much you can expect to lose with every 0.5% and every 1% raise in the interest rates. It comes down to with a half percentage rate. I think you lose something like kind of at least 12% of your principal on your bonds, things like that. So I'll do that probably the next week or two once we get into towards in the middle of November. So, okay, how much of a percent drop would you expect? The example you had a few weeks of drops, but then turn quickly. Again, I'll do a little talk on that because I have it already figured out from some of the bond sites that we go to, and historically how much of a drop you can expect in your principal on your bond holdings, and it moves pretty fast. I mean, you're going to lose 12-15% on your principal, although this has been projected for a while. and it can get up to where if you get almost up to 1/4%, you're going to lose almost a 25% of your principal on your bonds. So I'm going to go ahead and share the screen real quickly, and we'll see if we can, let's see here, open it up to a few more questions. Questions on cycles, not the bonds. Okay. I don't know. It's hard to say how on the cycles it doesn't really measure how deep a correction is going to go. It just tells you to expect it. Because there's so many other factors as far as interest rates, where interest rates are, or this turnaround in earnings, that kind of stuff that they can project where a bottom is. Like the last cycle we could have. I think it was in 2012 or something like that. It wasn't much of a bottoming process because we were at zero interest rates. There's only so far you could go down. Okay, let me get the screen share up, and then we'll. If you want to type in some questions, that'd be great. Okay. You see the chart? Okay. Not seeing anybody typing anything in. Nobody has any questions? Oh, Nugget. I'm sorry, my fault. Let me pull that up. As far as the gold miners go, I'm not wild about the gold miners, especially with interest rates going up and also the the dollar getting stronger. However, I think you probably have an opportunity for a trade on gold mining stocks. Part of that may be due to uncertainty on the election. But I do think you put a bottom in over here, stocks like GG, American Barracks, ABX, things like that. I think you can get a short-term bounce on those. You're seeing some a pickup at the 14-day RSI, getting kind of bullish. These are conflicting though. This is telling you that they're still bearish on the ADXR ratio. You're not seeing much accumulation, and this 30-day stochastic is still down here. But just things that I'm looking at. I think you've got a short-term bottom, and you may, as we go into election, have a chance to get a short-term trade. By that I mean a couple days at a time. You're not looking to buy gold and hold on to it for the next 2 months or anything like that. But you could get a short-term trade because I do think we've bottomed out in this thing. If you get on this thing here, you could possibly get a trade from this 13, 14 area up to around 16, 17. See if that gap's filled. If it bounces off of that, you can get out real quick because that means it couldn't fill the gap. Let's see. When should we buy long ETFs? This is going to be a short trade, so I don't know how much we're going to make. I'm hoping to make 4 or 5% on it in a couple of weeks. Today we're down on the market. This might be something to buy the long ETFs today. And what are the 4 leveraged ones? If you play this thing back, you'll get the four long ETFs that they are. UDOW, SPXL, I think it's TQQQ, and URTY. That'll be the Russell, the NASDAQ, the S&P, and the Dow. I think you could probably buy those today. You had that bounce yesterday, but just for a couple of weeks, and just keep an eye on the market letter and the momentum index, so we can see that we're going to get that thing, and hopefully we'll get a break out the new highs, and then we'll get rid of them. Maybe we'll pick up 4 or 5%. The market picks up 3%. You could make 8 or 9% even. Okay, what do you recommend for a long-term investor in T? This is 18. All of this isn't due to earnings. This is due to the reason why AT&T went from 30 up to 43. mainly because of the dividend they paid. And now this was people unloading the dividend. Here you can see they started, selling it here. This is the up-down ratio, which I like. It kind of shows the trend, or people buying or selling it. When you're having something going like this, sideways, and you're seeing this thing coming down like that, that means that the institutions are usually going. And the faster this thing, the steeper this is, the more institutional plays you have. I think institutions were getting out over in here. This is just due to the merger stuff. People knew it was going to go on, and they don't know how that's going to affect it. So you had that spike down. How this thing's going to play out over the next few years, if you're in it, I don't know that I'd be selling it right here, because I think the dividend still is a good play, especially if you're older and you're looking for some retirement. You're retired or something, you're looking for income. AT&T, I still think it's a good play. You're not going to roll over, and content in this business is a good thing. Look at Disney; they're up because of the content they own. So if you own it, I'd still hold on to it. I don't see much downside in AT&T at this point. As far as what the upside potential is, you're going to have to wait to see how this merger plays out, and also if the merger even takes place. I imagine it would, though. Okay, that's about 30 minutes. I don't see any more questions coming in. I hope you got something out of that. Look on Friday on the market letter, which comes out after the close, and that will update you on the counts for the for the CTI and the momentum index, so you can see how we're going. But as I said, right now cycles A, B, and C are bullish, D and E are bearish, and how long this cycle is going to last. It could be 2 weeks, 3 weeks, 4 or 5 weeks. But then, sometime after the election, I think we have another leg down. That's when hopefully we can reset the cycles for the long term and be ready to go. One last message coming in here, and then we'll wrap it up. Okay, I guess we don't see anything. All right, thank you for joining me. I hope you got something out of it. Again, if you have any questions that you couldn't get to right now, please just send me an email to those. I just much more questions here. CBS. Anyway, you can email me at dblake@marketedge.com, and I'll get to them. And next week there will not be a webinar because we're moving offices. So I'll join you here in 2 weeks, and we'll get an update on the CTI at that stage, okay? Thanks again.